Hello, my name is Ayako Yasuda. Today I will talk about my research with my colleague Kier Young on fund managers' sustainability goals, financial, moral, or impact. Sustainability is an umbrella term whose meaning for investor critically depends on their goals. We have a financial goal where it is the concern of the investors is the sustainability of the financial value of the portfolio. In this case, investors' objective is pecuniary and the focus is narrow. We also have a moral sustainability goal where the objective is, let's say, the emission level of your portfolio or worker welfare. Now you have a sustainability goal that's non-pecuniary, but your focus is still narrowly on your portfolio. Finally, we have an impact where your sustainability goal is about what is the broader impact of your action as investor on the environment or the society. So rather than the level, you're interested in what change in emission you're inducing from your portfolio management. So we label these three sustainability goals: financial, moral, and impact. And we developed a machine learning model to measure fund managers' goals. Using the US mutual fund database, we ask which sustainability goals do these funds pursue? Do sustainable funds pursue pure or hybrid goals? Do they tend to pursue some goals together or separately? And are impact funds more activist? We find that the majority of US sustainable mutual funds pursue financial and moral goals rather than impact. Particularly, hybrid financial moral funds are popular and large, whereas impact funds are smaller and more rare. Moral strategy is easier to combine with financial strategy, but not impactful. These three sustainability goals we identify map to three types of investors. Sam, for example, says, I object to private prisons. If a mutual fund I invest in holds a shares of a private prison operator, that bothers me. Inger says, I feel passionate about making access to clean water more accessible and equal, and I want to back companies that promise to make it happen, tilting more into impact arms. Finally, Ellen says, I sense this shift of the economy towards decarbonization. This is creating a new kind of risk, stranded risks, transition risk, and I want to climate proof my portfolio. These three people correspond to moral, impact, and financial sustainable investors. We can also map these three goals to a 2x2 table where one dimension is what we already know very well, whether the investors have pecuniary only or pecuniary and non-pecuniary preferences. What is maybe less more difficult to distinguish is the between impact and moral. And this maps to the two schools of thought of what is the social responsibility. One is consequentialism, the other deontology. These are both philosophical terms. And according to consequentialism, what is best or right is whatever makes the world best in the future. So it is that maps to the impact, and impact is about the outcome. It's output oriented. Whereas according to deontology, the action itself is inherently right or wrong, and it's not based on the outcome or consequences of the action. And that maps to the moral investor, Sam. It's about his conscience that he's concerned about. Now, what's interesting is only the impact goal is explicitly focused on inducing the change in generation of externality. Our machine learning model is the BERT model, and the text that we use to train this model is the fund prospectuses of US mutual funds. We start with the sustainable fund prospectus, and we break them into single sentences. And using the ones that contain ESG-related keywords, we manually code them into financial, moral, and impact, and train the BERT model, which is already pre-trained on natural language processing, so that the model can then take any sentence and code them into these three types. Once the model is well trained and tested, then we apply this to the entire universe of US mutual funds prospectuses. Using this model, we find that US fund managers' sustainability goals are primarily financial and or moral. And actually combining this moral and financial as a hybrid is a very popular strategy. Impact fund, on the other hand, are less prevalent, and also each fund size is smaller. When you look at the correlation between these goals, we find that financial and moral goals are positively correlated, whereas financial and impact goals are negatively correlated. We use MSCI ESG ratings to distinguish between these three funds in what they actually do. MSCI's current ESG ratings measure the financial significance of ESG issues. This diagram on this slide comes from the MSCI company website. MSCI ES ratings are not a general measure of corporate goodness. This also quote comes from the MSCI company website. So in other words, their ESG ratings do not measure a firm's alignment with moral values or a firm's impact on the environment and society. So consistent with this methodology focused on the financial significance of ESG issues, financial funds hold stocks with higher MSCI ESG ratings. On the other hand, moral funds, they express their values mostly by holding less stocks in the sectors that are deemed undesirable. So they hold significantly less portfolio weights in energy, defense, casinos, and tobacco sector stocks. So the moral values are expressed by categorical exclusion. And for the stocks that they do hold in their portfolio, the funds that are moral are passive. Finally, impact funds are found to be more activist. They are associated with higher support for environmental and social shareholder proposals, and they have a more activist investment style. These proposals are costly to implement, so the non-pecuniary preferences of impact investors justify the higher level of support. And in contrast, financial funds are more likely to abstain or not support these proposals, and moral funds are indifferent. So this suggests a trade-off between financial and impact sustainability goals. Moral goals, by categorical exclusion, are easier and cheaper to combine with the financial sustainability goals, as long as the excluded sectors are not too good of a performer financially. So to conclude, we developed a machine learning model to measure investors' goals, and US fund managers' sustainability goals are primarily financial and moral. Moral financial hybrid strategy is popular. Impact funds' activist practice is the likeliest to induce positive change, but it's not as popular as the moral financial goal funds. Moral strategy is cheaper to combine with the financial goal, but is unimpactful. So these set of results that we find lead to two potential pretty divergent implications. One takeaway, which I favor, is the following. Investors have demand for impact, supposedly, but mistakenly, they might invest in moral financial funds because the ESG ratings and sustainable fund list do not measure impact and do not reward pursuing impact. If that's the case, then better measures of financial, moral, and impact sustainability goals and better measures of impact of investments will result in more flows to impact funds. Another, perhaps less hopeful implication is the following. If investors with non-pecuniary preferences lack appetite for impact or just simply indifferent between moral and impact, then all else equal, they would prefer moral financial funds. And that explains the dominance of moral financial funds in sustainable investing. If that is the case, then sustainable investing will not solve the environmental and social challenges of our times. Further insights are clearly needed, and we need to continue our inquiry on this very important question. Thank you very much for tuning in, and I hope you enjoy the rest of the conference.